Welcome to this video on interest rate risk, which is intended for those involved in the asset liability management function, including personnel and members of a bank's asset liability committee. In this video, we'll discuss the primary types of interest rate risk, which include repricing risk, yield curve risk, option risk, and basis risk.
Interest rate risk, or IRR, is the risk that changes in interest rates can adversely affect a bank's earnings or capital.
Repricing risk arises from timing differences between rate changes or cash flows from assets, liabilities, and off-balance sheet instruments.
Let's illustrate this concept with an example. For simplicity, let's assume a bank has one asset and one liability. The asset is a 15-year fixed-rate mortgage priced off the 10-year Treasury rate, and it's funded by a 1-year time deposit priced off the 1-year Treasury rate. Today, the bank is earning a 3% spread.
Let's review what happens in year 2 if market rates rise 2%. The yield on the 15-year mortgage stays the same at 4%, but now the liability has repriced and the cost is increased from 1% to 3%, resulting in a decline in the spread.
Yield curve risk comes from changes in the shape and slope of the yield curve as short and long-term rates move in non-parallel ways. To put it another way, yield curve risk is the risk from the changes in the shape of the yield curve.
For illustration, in the first quarter of year 1, banks are able to borrow short at rates close to 1% and lend or invest at around 5% for longer-term loans and securities. The bank in this scenario is able to take advantage of the spread and earn about 4% by borrowing short and lending long. What is the risk associated with this scenario?
Let's look at what happens over the next 2 years when the yield curve flattens. Short-term rates increase in year 2, while long-term rates decrease slightly. As a result, the spread between short and long-term rates narrows and bank margins begin to fall.
In year 3, the yield curve flattens considerably as short-term rates increase further. This change essentially eliminates the interest rate spread.
Let's look at a simple balance sheet example to quantify the impact of changes to the shape of the yield curve. Here, the bank originates a 15-year mortgage that is priced off the 10-year Treasury rate and funds it with a liability that is priced off the 1-year Treasury rate. In period 1, the net interest spread is 5%, but what happens if the yield curve flattens?
In period 2, the bank originates a new mortgage and earns 6.5%, but funds that with a liability that now costs 4%. As a result, the spread on new production has declined to 2.5% because of the flattening of the yield curve.
Option risk occurs when others determine the repricing of a bank's assets or liabilities. Options can alter the timing of cash flows or rate changes, and option risk is the risk that embedded and explicit options present to an organization. It can adversely affect earnings by capping asset yields or increasing funding costs, and can affect the economic value of a bank's assets and liabilities.
On the asset side of a balance sheet, mortgages and mortgage-backed securities can prepay or extend, while callable bonds can be called at the option of the issuer.
On the liability side, non-maturity deposits can be withdrawn at any time, while even time deposits can be withdrawn early despite prepayment penalties. In addition, some Federal Home Loan Bank, or FHLB borrowings, can be called at the FHLB's option. This list includes a significant portion of most community banks' assets and liabilities.
Let's illustrate option risk in more detail by providing examples of the impact of prepayment and extension risk. Here, we show a bank holding a 15-year fixed-rate mortgage. The bank has funded the 7% mortgage with a 3-year time deposit that costs 4%. In this example, the bank will earn 3%.
However, what happens when general mortgage rates decline in period 2? Let's assume that interest rates decline by 2%. Our mortgage customer refinances or prepays their mortgage and is now paying 5% versus 7% in period 1. Assuming the bank is able to keep this customer, it's now earning a much lower yield on the asset while still paying the same rate for the time deposit. As a result, the spread in period 2 has declined from 3% to 1%.
Let's review another example. Here, we have the expected average life of a typical pool of mortgage loans, assuming interest rates remain stable. Although the ultimate maturity of this pool of mortgages is 30 years, the average life is much shorter due to payments over the life of the mortgages. In this case, the average life is 4.5 years, and the bank can expect to receive most of the principal on this pool within the first 10 years. In this scenario, the bank will reinvest principal received at the current and stable market rate environment. But what happens if rates increase by 100 basis points?
In this case, prepayments slow because consumers are not refinancing their mortgages as quickly as originally expected due to higher rates. The average life of the pool extends to 6.5 years. As a result, the bank will receive principal payments at a slower pace than originally expected, and these mortgages, which yield a below-market rate, remains on the balance sheet for a longer period of time. This is called extension risk.
What happens if general market rates increase by a greater magnitude? Here, mortgage rates have increased by 300 basis points. As a result, prepayments slow down considerably. The average life of the pool extends even further to 11 years, and the bank will receive a much smaller amount of principal prepayments in the first 10 years compared to the previous two scenarios. The bank will hold these assets, earning a below-market rate on the balance sheet for an even longer period of time.
We've just discussed and illustrated how option risk can impact a bank's earnings. But how does option risk affect the value of assets or liabilities? Well, it depends. Bonds with options, such as those where the issuer has a call option or the borrower has the right to prepay, experience less favorable changes as market rates change compared to option-free bonds. This is negative convexity.
Let's take a residential mortgage pool that is part of a mortgage-backed security, or MBS, and illustrate the impact of embedded options. When rates fall, investors expect bond values to rise, and this is certainly the case with MBS portfolios. However, their values do not rise as much as option-free bonds, such as Treasury notes. This is because mortgage-backed security investors are at a disadvantage since prepayments will accelerate on the underlying mortgages, causing the security to be paid down faster.
When rates rise, the value of the mortgage-backed securities will fall at a greater rate relative to option-free bonds, because borrowers slow their prepayments, causing the security to be paid down at a slower pace. A portfolio of option-free Treasury bonds, which have consistent cash flows, has positive convexity, while the MBS shows negative convexity. This factor is why mortgage-related investments are often at more attractive yields than option-free bonds, to compensate the investor for the uncertainty tied to the cash flows.
The final type of IRR we'll discuss is basis risk, which occurs when different indices do not move together. In other words, it's the risk that the rates a bank bases its asset and liability pricing upon will move in a way that could negatively impact earnings.
Let's look at an example. Here we have a commercial loan priced off the 3-month Treasury rate, funded by an FHLB borrowing priced off the 3-month rate from the FHLB index, resulting in a spread of 2.25%. It appears this bank is well matched because both indices are based on identical repricing frequencies. But what happens if these rates change disproportionately?
Here, the FHLB rate increases 2%, but the 3-month Treasury rate only increases 1%, resulting in a decline in net interest income, despite having a matched repricing frequency.
Two questions that you can consider as you look at your bank's balance sheet structure include: which of these risks are most prevalent in your bank? Are your board and management committees apprised of these risks and any potential impacts?
In summary, we've discussed the types of interest rate risk every bank faces and provided examples to illustrate how these risks can impact a bank's net interest income and economic value.
As we conclude, we'd like to remind you that the FDIC has additional videos and resources that can be found on the Banker Resource Center at www.fdic.gov. If you need additional information or have questions or comments, please contact your bank's case manager or email the FDIC at supervision@fdic.gov. Thank you for viewing this video. We hope you found it both useful and informative.